Welcome to the Broken Pie Chart Podcast, episode 214. I'm your host, Derek Moore. With me back once again, Jay, by popular demand, Jay Pestrichelli, CEO of ZEGA Financial, my semi-permanent co-host. How you doing today, Jay?
Doing well, Derek. Popular. You think anybody is asking for me? Is that what you're insinuating? Or is it just it's popular with you for me to be here?
It's both, but people do like when you're on. They like when Mike's on too. They like, I told you, when we don't necessarily agree on everything that's out there and we take some different opinions. So we'll see how we do today. But yeah, no, it's, it's the banner. All right. So here's something. I don't know if we disagree on this, Jay, but for the past year, I kind of made the comment, hey, if I knew where the dollar was going to go, I could make a pretty good guess on where the equity market's going to go. And I created a chart. And basically, it's kind of interesting. The high in the dollar. And so when I say the dollar, it's the US dollar index, which is heavily weighted against the euro and some of the European countries. But the most recent high in the dollar was in September, and Jay, the S&P 500 was at its lowest point. Some people think it's the trough in the bear market, yet to be determined. But I don't know, Jay. I mean, the dollar has come down, and markets have gone up. And to me, this is an Occam's razor thing. And I've been talking about this for a year. But tell me I'm wrong.
Okay, so look, I'm going to give you a few points. You're right. And I'm going to say you're a little guilty of a chart crime. It's a term we use here within the inner discussions of ZEGA, where someone makes a chart to make it look like it's their point. You're not wrong. When the dollar, was trending up through September of last year, the market was going down, but not at the same angle, right? The market was down, then it was up, then it was down, it was up, and it was down. But the dollar had a very nice steady channel to the up. So, and then the dollar is back down. The dollar is actually, according to your chart, right, to the same place where it was a year ago in April 2022, yet the stock market is not. So while there's definitely an inverse correlation, I'm going to tell you that, it is definitely not, like a minus 0.8 on the correlation scale if I was using that, right? It's I would say you've got a point, but I'm not exactly bought into it. However, and by the way, I was just being a little argumentative for the peeps. That's what I want to hear. That was just for you. But look, you and I actually do agree on this, right? On days when the dollar is up, the market tends to be down. You could look at that. I don't know though, Derek, is it the tail wagging the dog with the dollar, or is there a different dog in the fixed income market that impacts the dollar that impacts, then the market? Is it like two dogs tied together by a tail? Like, I don't know, right? There's a relationship there, but like, what is this, right? Is this the pre or the post version of what's making the difference?
Is it a dog just running around in circles chasing a tail? Yeah, I mean, look, it's on, and I haven't gone back to the all-time high, but even, when the market was 4,500 or so, the dollar was lower than it is today. And I think it's less than a coincidence. There are people who do analytical, fundamental valuation. And I think people have the dollar in their models because all these multinational companies, and we'll get to some of the biggest companies and their impact on the S&P. But I mean, Jay, if revenues are coming from overseas, a strong dollar reduces those foreign sales because when they're brought back to US dollars, it means your revenue is less.
Yeah, they report in dollars, right?
And they report in dollars.
Yeah, I get it. I mean, but that's like what they say. The proverbial they say 40% of revenue of the S&P is now related to some sort of foreign currency, right? That's a pretty big chunk. And so, yes, I definitely think it has an impact. But, a lot of people, think it's like, well, it's, the foreign currency, the Forex market is a zero-sum gain. And while you're making it now, or it's costing you now, it can pay you back later, right? Like, is it a wash, or does it really trend over time?
I think there are levels of inconsequentialness. That's not even a word, but I'm going to go with it. Where the market is indifferent to this. I just made it up. I can do whatever I want. It's my
Yeah, it's
podcast.
episode 214. You can do whatever you
Yeah.
want.
Maybe episode 1 through 10, I can't do that. Episode 214, sure. What I'm saying is, though, I don't think you can look at the dollar and say, when it gets here or here, I think once it passes a certain level, it starts to be a problem. And I think clearly it was at levels where it was a problem. There are other times when the dollar is really weak, and that's helpful for international sales. But I think you have this middle range, and I'm not, I mean, I can't tell you the exact levels, but I just think it doesn't matter when it's in a certain range, but it matters when it gets really high, and it matters when it gets really low. And I think there's a relationship. So that's what I think.
There's definitely an inverse relationship. You're right. So stronger dollar is typically worse for U.S. stocks. I get that. So let's talk about it. Like not to belabor too long on this. So if the U.S. Well, let me make one more connection. Right. I always connect the reason why dollars move has a lot to do with the need to purchase treasuries, U.S. treasuries, because you can't buy treasuries in euros, yen, or sterling, right? You have to buy it in dollars. And so when there's demand for U.S. yield, there's demand for U.S. treasuries, the dollar has to be bought, right? Am I correct on this?
No, I think that's right. Yeah.
Okay. So now the dollar gets bought. And so that means supply demand, there's less dollars around, and the dollar goes up in value because foreign investors want U.S. yield, right? They want, our paper, essentially, right? They like their paper over their paper. However, if the Fed stops raising rates, I went right into interest rates, didn't I? Like none of our prep talked about interest rates, and I went right into it. So my apologies. And it wasn't a lot of prep, but we didn't touch on it. But if the Fed stops and Europe continues to raise rates, because they're still aggressive, right? They're at the 50 basis point range, right? Lagarde raised 50 bips last time. So if they continue to raise rates, there will be less demand for the dollar because there will be more demand for yield of European bonds. So is this one of the things that, hey, if U.S. bonds don't look as attractive across the world, that in and of itself will help push the stock market higher? Have I connected all those dots properly in your mind?
I think so, and I think it goes to the flow of currencies. I think it goes to there's been news about the dollar swaps and some of the things that we'll put all three listeners to sleep if we start talking about the dollar swap market. But I think that's right, and also just from a trade standpoint, if our dollar is weaker, in theory, our stuff will sell more stuff overseas, and vice versa. I think you make an interesting point about Europe. I mean, you and I forget which podcast it was, but I was saying, Powell is probably calling Christine Lagarde saying, "Hey, come on, like we're raising rates, you're doing nothing." And this was like a year and a half ago. I mean, come on already. So, yeah, I mean, and I think currencies also are very related to interest rates, relative interest rates between one another. So, yeah, Jay, I mean, I think that's right, and I think if other parts of the world catch up, we should see the dollar decline. We'll see what happens. But Jay, also, when we think about revenues and we think about margins and dollars and foreign sales, a lot of this comes back to margins. JP Morgan's Guide to the Market put out their, they always put it out every day now. It's a great piece. Their Guide to the Markets. It's a PDF. It's quite voluminous. So I'm making up words today. Fourth quarter, though, earnings, which I think we're done. Maybe there's one other company that reported today. I have no idea. But the fourth quarter net margins were 10.9%. They were, pushed in the upper 13%, 13.5%, 13.3%. So they're off their record levels. And I think on a year-over-year basis, so they also have a chart, share of EPS growth. So think about what makes earnings grow. Well, you can have revenues that grow, you can have margins that grow or compact, I guess, contract. And earnings per share is earnings per the S is share. So if share count goes down and you have the same earnings, your earnings per share goes up. Jay, margins in 2022 contracted 16.4%. Revenue is up 9.6%. Share count went down. And so that actually is a positive for earnings per share growth. All told, earnings per share growth in 2022 was negative 5.5%, 5.6%. Jay, most of this decline was a margin contraction. Margins came down from the record highs. It's pretty easy to see. And I guess, next year's earnings estimates, I think, are expecting above a 12% margin. And here in Q4, it was 10.9% margin. So I don't know. I mean, to me, inflation helps revenues because it's nominal that we report, not adjusted for inflation. But I don't know. To me, I think this is one of those things that is not being talked about enough, and that's the margin story, Jay.
Yeah, I mean, margin. So, what are the things that impact margins, right? There's costs, obviously, are a big deal, right? Margin is the amount that you convert off your revenue to earnings, right? So, when I think about that, right, were costs higher for companies in 2022? Yeah, right. I mean, inflation was there, right? Labor cost, material cost. Those things were definitely pretty bad, and nobody should be surprised that we had negative EPS in 2022, right? I mean, this is it's been talked about for a while. Although I think we talked about, was it last week where we talked about how the analysts got it wrong right up until the end, right? How they were still projecting positive growth, and then all the way up until January, right? Because we're still talking about the period that ended in December, Q4, the fiscal year of 2022. Yeah, I mean, so this is, maybe it was a little bit of a surprise, right? But this is what the market got ahead of when it bottomed out, 6 months ago, if that was the bottom. I'm not saying it was, definitely not locking that in for anybody, but that has been the most recent low, and that, here's the data. 6 months later, the market, got this number, right? Whether it knew it or not. So I don't know, Derek. I think the margin contraction is a big deal, but I still think the revenue piece is kind of an equal offset, right? To say that revenue was up 9.6% last year, it's like, wow, companies did pretty well. They just made more money because they had to charge more money, but that also is probably reflected into the margin side of it as well. So to me, that's what I look at. They just didn't make enough for what their costs did to them. That's really what I would say.
Whenever I ask somebody this question, and you can see it on the chart, but I'm going to go to the average from 2001 through 2021. When I ask people, I say, hey, what's the average annual growth rate of revenue? Nobody gets this. It was actually 3.8% in this case. And I think over the long run, it's more like 3.5%. So that's been the growth. The growth of margins. So I let me be careful how I say this. Not like I'm going to say something bad, Jay. Just I have to think about, when you think about growth,
what's he holding up for? Okay, go ahead.
So margins on average have gotten 5.1% better annualized from 01 through 21.
So let me say it a different way. Their contribution to EPS was a positive because companies were, doing more with their revenue, right? Margins were good to the tune of adding 5%.
Yeah, like let me give you some examples. I mean, like 2012 margins were 9.5%. 2021 they were 13.3%. We just told you, 10.9% was the margin in. Of course, I mean, for anyone out there, is like, what is margins? You sell something for $100. It costs you $90 to make the widget. So you make $10. You have a 10% profit margin. So I know most of the audience is like, I know that. But let me make sure everyone's on the same page. So yeah. So margins have been getting better over the years. And some people look at that and they say, well, we have more technology in there. You have companies with you don't need the 5 factories and the thousands of employees. But yeah, Jay, I mean, I just think it's sort of interesting to look at this, and a lot of the growth has come from margins expanding. And then, of course, Jay, and the other thing too is we were on it a year and a half ago. The multiple contraction. We're trading at roughly 18 times next year's earnings. We were at 21 or 22 forward earnings that were higher. Remember, we were 21, 22 times forward 2022 earnings at the end of December of 21, and those were really high estimates. So we were probably trading closer to 30 times actual. I'm making that up, but I'm doing it in my head.
Yeah, that's a good way to put it. That's new information because we haven't talked about that, right? So the market really got it wrong, right? Their estimate on forward earnings, and then being willing to put a premium on the market at that high level of what'd you say it was 21, right? Versus where we are 18. And what is the long-term average? 16? Is that kind of the?
I think it's a little higher. It's probably 17 something. I mean, I think we're close.
Well, that multiple, right, I always look at the multiple as kind of the appetite for risk, right? And now all of a sudden, when you have a risk-free rate paying you, what's that paying these days? 5, right? 4.5. You don't need to take
4.6,
risk. You don't need to take risk now. So that's always going to help, bring the multiple down, right? So zero rates kind of give you the whole Tina. There is no alternative approach. You got to go to stocks to get your returns. And now you don't. There you go.
I mean, to put this, let me just give you an example. So let's say we're trading at 4,000 and we think the market's going to have earnings of $250 over the next year. That's 16 times forward earnings. But if, you're trading at 4,000 and your earnings aren't 250, they wind up being 180. Well, then you would have been trading at a 22.2x multiple. So anyway, I think we beat this enough, Jay. But the point is, margins. To me, margins are the thing to look at, and I think that has a lot to do with inflation as well. And if we think inflation's done, okay, that's one thing. Although, Jay, I'm not sure that everyone's just not raising prices because they can. Like, you go to some business that really is not affected by inflation, but they're just going to raise their prices because everyone else is. Don't you think that's happening too?
I mean, that definitely happened out of the gate, right? There's a lot of companies that said, the consumer is strong and can absorb higher prices, right? They didn't see that reaction. I think that's business will do that until a lower player comes in. But some businesses can and some businesses can't. Let's think about it. I had this conversation with Mike today, your other semi-permanent co-host.
Yes.
Where we talked about airlines, and I was like, let me get this straight. Like, tickets now, I don't know if you've traveled, Derek, maybe not so much, but plane tickets are ridiculous. It feels like everybody always says that. I'm like, oh, I remember when tickets were $200. But in all honesty, it seems like oil is where it is. It's kind of where it was last year. Maybe a little less even. And the fleet is what it is. And I'm like, how are prices double? They just seem to be double. So, that's an industry that will charge when they can, because sometimes they get squeezed pretty badly. But yeah, I mean, I can't explain why margins on airlines, require a higher level of a ticket charge these days than a year ago, 2 years ago. I don't get it. I don't get why it's higher. The labor cost is not that much higher, right? I don't believe. So what's the other input? The equipment, rental at the airport.
Everybody was locked up for 2 years. They're like, I'm going somewhere. So
they're filling planes and they're charging more. I have not been on I haven't been on a plane with any empty seats in at least a year, right? They're all packed. So it is a demand thing, right? So I think you're right there. So they can charge more.
Yeah, I would also say since pre 9/11, I don't know about you, but traveling for business, I remember getting like whole rows to myself. There'd be empty planes, and airlines used to run those routes where they really didn't fill up the planes. They seemed to do a better job of really. Like I'll give you an example. There used to be like 20 flights a day, I feel like, between Phoenix and LA. And then later on, I remember looking, and it's slowly but surely like the number of flights that went between the two cities just dropped because you drop the capacity, you increase the demand. But anyway, all right. So let me get to this other thing because I think this is pretty cool, and no one ever really talks about this. And what am I going to tell you about? Well, Sam Rowe on Twitter had put something out, and he said, "Okay, the S&P 500 index turnover crept into the headlines again." And what he was explaining was Silicon Valley Bank and Signature Bank were members of the S&P 500. They were part of the index. On March 15th, both stocks were dropped from the S&P 500. They were replaced by Insulet and Bunge. I have no idea what those companies do or if I'm pronouncing the names right, but welcome to the S&P. And then from a regular quarterly rebalancing on March 20th, FICO, Fair Isaac, sounds like a credit reporting agency, replaced Lumen Technologies. And you might say, okay, that's not that interesting. But remember, the S&P is an index, and the index is made up of all of these different companies. And so when you think about like what's the market cap of the S&P, it's probably something like, 30 something trillion dollars. And all of the earnings by all of those companies, and the S&P, of course, is a weighted index. Apple and Microsoft and Google have a higher weighting in the market because they have a higher market cap, the number of shares times your price of your stock. But all of the earnings, all of the revenues, all of that stuff is aggregated together. And then you wind up with what we were just talking about. What's the earnings per share of the S&P? What's the revenue per share of the S&P? Things like that. So I did a quick back of the napkin calculation, Jay, and I said, what's the difference in revenue, in share count, in net income of taking out those three companies and putting in three new companies? And all I did was I looked at, 2022 full year earnings for these. And it was interesting. By swapping those out, you actually take off 860 million shares. So you reduce the share count. And then you actually increase the revenue by about 44 billion. You increase the net income by 741 million. And, that actually, an analyst, by the way, like they know this. It's not like I'm talking about it on the podcast and the head of Goldman Sachs's, research division doesn't know that there are changes to the S&P. But this does sort of impact a little bit on some level the per share numbers that we all see. So I don't know. I thought it was interesting to bring this up, Jay, and no one ever really talks about this.
Yeah, so the construction of the index itself will change the fundamental data of the index, right? That's what you're saying, right?
That's
You've
right.
impacted the number of shares, you impacted the revenue, you've impacted the margin by swapping out the components. Now, arguably, with Silicon Valley and Signature Bank, their numbers would have had a bigger impact in here, right? I mean, is that the point of the swap out, right? Your numbers are kind of pre-failure of those two banks. Am I correct on that? I guess the share count is what it is, but the revenue is gone, right? So
that's right.
Yeah. So the share count, that's a nice change. The revenue, so it's still better to put a stronger company in than leave the weaker company in. But it looks like it will have an interesting, impact on earnings per share, and because of both the share count and the revenue.
This is peanuts compared to the whole market. I mean, Apple bought back $89 billion worth of stock last year. Apple's net income was in the billions of dollars, so to add 740 million of net income just by swapping these out, assuming they do the same thing that they did last year, this year. But it's interesting. But the big companies still have an outsized role to play. And, JP Morgan's income and revenue is massive compared to some of these other companies towards the bottom end of the range,
Compared to Bunge, we got to look at Bunge.
Bunge, I'll tell you what Bunge is. Bunge is
Ticker
that BG?
BG, right? BG. Now look, now we're on the fly typing in BG in our platform, but we're
No,
gonna
no,
look.
I wrote it down. I didn't give it to you. 67 billion was their revenue. 1.6 billion was their net income. So that's a really strong company. I shouldn't say it's a strong company. Like I have no idea what they do. I really don't. But I'm saying you're bringing in 1.6 billion of net income if they do the same thing they did in 22 and 23.
Yeah.
Um,
Okay.
so it's
Let's go Bunge. Yeah.
now Silicon Valley Bank, by the way, had 1.5 billion in net income. So I guess it's sort of a swap when you look at it that way.
Is this like in the NFL draft? The last, the 500th and the 501st, because there's 501 stocks in the S&P 500. Are they like? Do you think of them as like Mr. Irrelevant or in the NFL draft? Right, the last player drafted, isn't that the
Mr. Irrelevant? That's right. That's
yeah,
right.
yeah. And Mr. Irrelevant, I believe, took the 49ers to the playoffs, didn't he, last year?
Yeah, and look, you and I have no dog in the hunt. Is that it? When it comes to the 49ers,
No.
but for his injury in the first drive, I mean, who knows? Who knows? I mean, the guy gets hurt, blows out his elbow like a pitcher. All right. So anyway, I'm going to move on from this, but I think it's something that's never talked about, and really,
Whenever I think of you talking about indexes, I always think about your, trivia question you ask of, all right, what, was the number one stock in the NASDAQ 100, back in 2001, right? And because it's a very different composite, but that process of managing the indexes, well, if anybody, I'm deliberately pausing to give people a chance to think of the answer if they haven't heard it already. I believe you've asked that question on this pod. We've probably done a podcast entirely on that. You
yeah.
want to give the answer as the largest allocation of the NASDAQ 100 in the year? Was it 2000?
Sirius satellite radio.
Yeah, it was like 9% of the index, right?
Bigger than Apple, bigger than Microsoft. That's right.
Yeah.
Think about that.
And so just indexing is just a very normal thing with the swapping of stocks. And that's part of the reason why, that methodology of, dropping the underperforming stocks and replacing with the better performing stocks is part of the reason why indexes do what they do, right? That's actually an investment philosophy that I think a lot of people just think it's static. It's not. And I think you're pointing out something very interesting that when you do the swap, you actually impact the fundamental data that comes out of that index. So,
You do. Now, I will say, Jay, that so they have a committee, the S&P, and they decide what goes into it. And there's some criteria, like I think they have to be profitable over the last quarter or 2 quarters before they go into an index. That was a bit like with Tesla. That was a big deal where Tesla had to have those positive quarters. And you might say, well, wait a second. What happens to the S&P through changes? Nothing really. And the reason is they smooth out the index and they use what's called a divisor. And so rather than have, the S&P be like, okay, it's $32 trillion today because that's the market cap. Well, that they use a divisor, and the divisor is what they divide the market cap, I think, by to get the index level. But when companies have splits, when you have, one company buys another, Tesla goes in, and Tesla was a pretty big market cap, they don't want the index to jump just from any changes. And so they adjust the divisor to smooth out the index. So it's actually kind of interesting how they do that. But anyway, that's a little indexing 101.
yeah, indexes are interesting, right? And the Dow does a completely different set of math, right? It's based on share price. So it's completely different than the way that the S&P
The
does.
weighting. No, that's right.
Yeah.
Jay, speaking
Yeah.
indexes, though, I thought it was interesting, and you mentioned you saw it on CNBC. I hadn't seen it. And it's where the returns have come from this year. The S&P is up year to date. And let me just find my doc that I'm looking at this. Yeah. So Meta, Amazon, Apple, Microsoft, and Google, they are up this year. But if you take those companies out of the S&P 500, I think the S&P would be flat. So like the remaining There's actually 505 companies, I think, in the S&P right now, because you have Google A and B or two share classes.
Yeah, you may be right. I'm not sure. I think it's 5. Yeah, it's more than 500. We both agree on that.
I think it's 505 according to S&P Global's website. But what do they know, right?
I mean, it's only their index.
Maybe they know something. Anyway, but I mean, it's Jay. Most of this happens. It's these 5 companies that are driving all the returns, and
so yes, but this is not unusual. Where big tech pulls up the whole S&P, right? It was a dig on indexing through 2017, 2018, 2019, that it was just 5 stocks that really drove all performance. This is not new, in my opinion. Although I'm looking at it thinking, where's Nvidia? Because that has had a rocket year. Where's Tesla? That's had a rocket year so far. So I don't know, who put this data together, Derek?
I think it's Goldman Sachs.
Again, Goldman Sachs. We can't have a talk with those guys. I don't know who's handling it. I'm sure I must know more than Goldman Sachs at this point.
I always say, I forget the gentleman. Is it Koster or Kostner? Is their chief economic or chief strategist? And I always say, I'm sure he knows more than I, because Goldman's decided to make him their chief strategist instead of me, if for nothing else.
Did you apply? Did you even throw your name in the hat?
Well, see, that might be the issue. Maybe
right. You don't know. You don't know.
Jay, to your point, though, this is why you buy an index. Who cares?
Yeah.
This is you buy it and the return comes from where it comes, and that's great. And if it goes up, you're happy about it. I don't know. I mean, and part of the way you look at this, you say, well, okay, does that mean the remaining companies have room to run? Or, I mean, I haven't done that level of analysis, but great. And last year, these companies were bad. I think, Mick was pointing out, who runs our trading, a member of the investment committee today. He had put something out this morning we were talking as a group, and, I think it's Amazon, and I'll get it in a second. But yeah, I think Amazon, who was the other one?
And how much more they have to go, right? So the point was that they're not even close to kind of getting to where they were in the middle of last year, right?
Yeah, so Microsoft needs 23%, Amazon needs 80% more, Google needs 50%, and Apple needs 12%, Meta needs 83%. So these companies are still, Meta and Amazon especially, are really far down from their all-time highs. But they got pummeled last year. That's the point. And so we've had some recovery from those. I don't know what's going to happen the next 12 months. I'll let you know when it happens. But
yeah. Listen, I'm going to call a little bogus on this data point, but it has been big tech pulling up the S&P. The NASDAQ just had one of its best quarters since 2010, right? Everybody was putting big tech for dead, counting big tech for dead, and saying, that's over. There's going to be a rotation. These are the year's value is coming back. Sorry, Mike. I know you talk about value quite a bit. I'm going to bash it while you're not here to defend it, because I'm not fair like that. But look, I mean, this quarter is telling a different story. And I was looking at Nvidia. It's gone from 142 to 277 at close today, Friday, the last day of March, March 31st. That's almost 100%, right? Don't tell me big tech is dead, and don't tell me that's not impacting the growth of the overall market. And those stocks do bring it up. And you're right. It's the benefit of indexing. It's why we use indexes versus trying to pick stocks, because you're usually dealing with old news and there's a lot of information. And when a stock catches fire, you may not know right away.
I forget who said it, Jay, but with the AI thing and some of the chips, it sounds like a lot of people on CNBC were pointing to NVIDIA. Is NVIDIA the Levi's? NVIDIA to AI is what Levi's was to the gold rush.
Okay.
It's not the primary thing.
How about it's Cisco to the thing. Internet? Can we do? I'd like to pick one of those.
No, I mean, but
FedEx to the internet of shopping, right? Yes, I got.
No, but everyone made the money off selling to the people who were looking for gold versus everyone who went bust once the gold rush went bust, right?
Yeah, no, absolutely. It's why AMD did so great with the crypto mining, right? You're right. Like you can have like it is that is and listen, I don't know. I can't speak to the technical details of an NVIDIA chip. I've always thought of them as great graphics cards, right? But if they've clearly expanded past that. But I don't know why NVIDIA is better than, Texas Instruments when it comes to making chips for artificial intelligence. But that has been the thought. They're the one that'll be the tool that all AI programmers need to create the capacity.
It's always interesting. Yeah, who knows? By the way, this is why, you and I always say we buy, but we hedge. We tend to buy indexes like the S&P 500. We look to get the majority of that return, or depending upon the strategies we run. And then we have either downside buffers or hedges. And so, I mean, this is, you never know who's going to be the leading, the horse in the race, and you got them all. So, and by the way, Jay, I will just say, at the end of the year, if you would have said, "Hey, what's going to do the best the first quarter?" I'd be hard pressed to get anybody to tell me, "Oh yeah, it's going to be Meta, Amazon, Apple, Microsoft, and Google, and Nvidia." Yeah, Nvidia is going to be up close to 100% Q1. I don't know if anyone was making that call, right?
So I'm sure somebody, and they feel great right now. But yeah, I mean, and look, you and I always talk about, net interest margin rates are good for banks, and banks happen to be now like, the sector that is like scaring everybody, right? You're right. It's hard to know, right? It's hard to know the outcomes of sectors or individual stocks. So, like, why not just index? I know it seems like lazy. It's not. It's, if what's the statistic I've heard, and I've seen data on this. After a 5-year period, 95% of professional money managers do not beat the S&P 500. So it's almost like you got the answers to the test. Just use them. Use something like the S&P. It's okay. It's fine. I don't think getting it right better than most people who get paid to do it all day is bad. You're trying to make trying to generate returns, trying to create some level of predictability within a portfolio so you can have goals and you can manage your risk, all of those great things. Picking stocks, you could find yourself left behind. But an index, as we started out talking about it, will rotate out those bad stocks for you. The market has always, and I guess it's yet to see after this decline, the market has always historically come back and made new highs. Give it enough time, and it has. You can't say that for an individual company. Plenty of companies do not retake their old highs when you give them more time. Plenty of them just don't exist anymore, right? So using indexes is another way to avoid getting stuck in, a loser that's going to take you down with it.
You mean like Sirius Satellite? That's trading at $3.97 right now.
Former largest allocation in the Nasdaq 100. Yes.
Let me just put a little color on that, Jay. March 3rd of 2000, Sirius Satellite was trading at $63.25. Today, it's trading at $3.97. I mean,
wow.
Picking stocks is hard. But if you own the Nasdaq 100 index from that time, I mean, it took some time to come back, but eventually it did. I'm just looking at let me just pull up the Nasdaq 100 chart. Same sort of time period. Yeah, I mean,
it took a while to retake those 2000 highs, but it did.
It did. But here, beginning of March, it was 45.80. Right around there. It got back to 45.80 sometime in 2016. I think, yeah, sometime in 2016, and today it's 13,181. Sirius Satellite was $65. Today it's $397. I have no idea about their financials. I haven't looked at that company. I used to have one in my car, but
I have it in 3 cars. I still pay for it. I love it.
Yeah. Well,
Hair Nation. There you go.
Hair Nation. Yeah, there's a good recommendation if you're 1980 heavy metal.
You can tell a lot by a person when you look at the stations they have kind of marked for their satellite radio.
Yeah, no doubt. One last thing I'll mention before we do get to our recommendations for the week is I think sometimes people are too antsy or impatient to have markets get back to an all-time high. The market peak of 47.97 occurred in January of 22. JP Morgan's Guide to the Markets has this graph, and it says, okay, what type of return in the next 1 year period would you need to get from where we were now to the all-time high? And it's going to be a little less because the market was up the past 2 days since they ran this. But you need, 20.8%. So if you get that, you get an all-time high. If it takes 2 years, okay, all you need is 10.9%. I shouldn't say all, but you need 10.9% average annualized return. If it takes 3 years, 7.7% return. Jay, I mean, I don't think, who knows when we'll get an all-time high again, but like 2 years at close to 11% annualized return, that's pretty good. But a lot of people would say, are you comfortable, would you be okay having to wait 2 years for an all-time high? And they'd be really impatient. I don't know. I just think sometimes perspective is needed.
Well, let me throw a different perspective out at you. Here we go. So would you rather be in the stock market over the next 3 years and, hoping to get, what was the number you said, 7.7 to get back to the all-time high, or buy a treasury that, has significantly less risk and is probably going to pay you, just under half that? But that's the math that people are thinking about because there's an alternative now to stocks, right? So food for thought. Some people probably take that, right? If it's going to take 4 or 5 years, and you've made the case on a previous podcast how it could take, that's not your opinion, but you've shown the fundamental data that it could take 4 or 5 years to get back to the previous high. Well, maybe it's better to have a treasury during that time period. Take risk off the table. There's plenty of people that I know that we manage money for, you and I, that have gone that route, and they say, look, I don't know what's in store when it comes to the stock market. Maybe I should be in something like treasuries for a little while till, this all clears. And I didn't even know what that means till this all clears, but everybody has their own kind of definition. So, it's an alternative thought there. It's not the one we typically take, right? I definitely don't want to.
Well, hedged equity is really where we live, and
right. So why not take it in a way where you've protected against that downside and still have the upside to get those years where you can get a 10 or 20% return? But it's just
agreed.
It's the thought process that we recognize that's going on out there right now. So if you've thought about it, great, you're thinking about it. It's something that they should have a conversation with you about.
I would say, yeah, the fact 2020 when we went from the lows and we got an all-time high 2 days later, I'm making that up. The all-time high was reached that year again. That just doesn't happen. But I think some people are conditioned from that. All right, Jay, let's transition to, I think we have a joint recommendation this week. And I gave this as a pre-recommendation 3 weeks ago in anticipation of it coming out. But I'll let you run with this one.
I mean, it's Succession. I can't believe we even forgot to mention it last week. It's one of our favorite shows. Succession is back out. First episode, probably by the time the podcast comes out, the second episode will have already been out. And I know we were both pleased with the way that the first episode went. How, dysfunctional the family is always entertaining, and, the business aspect of it. And yes, Succession is the strong recommendation for both of us.
I almost wish, Jay, I mean, I'm obviously I've been watching every episode as they come, and this is year 4. This is going to be the last season, as far as I know. But doesn't part of you wish you could just sit down this weekend and just go through 3 full years of watching that? How enjoyable that would be, just to binge that.
I really should have binged it before. Like I said to my wife, I was like, we should have watched at least the last couple episodes before this one launched. But I picked right up where it left off. But yes, of course, it's definitely worth binging. Definitely.
I watched the last episode of last year right before I watched the new episode. I think HBO had it on right before, so I watched that, and it's every bit as good as I remembered it, for sure.
Good.
Although, Jay, you might remember you and Mick and Wayne back then were like, how have you never watched Game of Thrones? I never watched it. And I think I watched the whole season, every season, in the space between whatever the second to last season and the last season. But I had never seen it. You guys would talk about this, like the White Walkers or the whatever people, and I'm like, I don't even know what you're talking about.
Whatever people. Yes. You've just alienated half your audience.
No, I loved it. I watched it. I binged it. But that's what I'm saying. Like, think about that. You had to wait 6 months in between the finales. HBO is like, would you like to watch the next episode? Yeah, I would like to find out exactly what happened right now. And I just went right into it. So it's fantastic.
No, I know. It was a year and 6 months that we were waiting between those final seasons. It was torture. But I have, I don't know if I'm proud to say this or embarrassed to say this. I've actually watched every episode in, start to finish 3 times. I've gone through the thing 3 times. Once for myself, once because I really enjoyed it the second time, and then once with my son. So,
well, I think if you haven't seen that, it's I mean, that might as well been. So if you haven't seen Succession, if you haven't seen Game of Thrones, that's obviously 2 things. But yeah, Game of Thrones I can't wait to see how they land the plane and close out the series because I'm sure it'll be pretty good. But yeah, Succession for sure.
Yeah, Succession.
All right, Jay.
All right.
I think we've solved the problems of the investment world. It's all good, and Jay Powell is yet to talk to us, but he said the banking system is sound and resilient. Those are the words that they're using. So, all right, we'll wait to see what happens. Jay, thanks again for coming on.
Thanks, Derek. Have a good one.
All right, see you, everyone.